Thank you. So I would
It means
like
the other Svetlana will continue next. Okay.
Okay, thank you.
You're welcome.
So the topic of my presentation is the effect of oil prices volatility on prices in the domestic market. Empirical evidence from Russia. I'll try to do something. It's maybe because of the dynamic. So a bit about the context. It's not a secret that Russia is among top 3 largest oil producers in the world. Yes, thank you. And oil and natural gas industry are still play important role in the energy market, and despite the strategy to diversify the Russian economy still plays the important role in the Russian economy. And last 10 years, production of oil was increasing in Russia and reached the peak of post-Soviet period in 2019. More than half of the crude oil produced are sent for refining, and this share was less 10 years ago, but is increasing in recent years. And the price for crude oil for the domestic companies is one of the key factors of petrol prices in the local market. And petrol prices are much lower in Russia than in many other countries, but still a significant cost for people. The motivation of this study was to analyze how the volatility of oil prices affect prices in the domestic market, because it is expected that prices for crude oil and petrol in the domestic market should follow the global prices. However, the real crude oil prices, I mean prices in basic prices in basic year, are less volatile in the Russian market. And it was not decreasing in 2014 and in 2020, despite sharp decrease of oil prices in the global market. The main reason is the tax system and so-called damping mechanism in Russia. What does it mean? So under our current tax system, the state compensates companies for keeping fuel prices stable in time of high oil, and companies pay into the state budget in case of low oil prices. So when prices are falling down, companies try to maintain their profit, their margin, and so keep prices in the current market higher than it is expected. So the research hypothesis is that the volatility of oil prices in the global market force oil companies to push up prices in the domestic market. The methodology is based on so-called after-regressive distributed lag model. This model is a linear time series model in which both dependent and independent variables are related to not only to contemporaneously, but across locked values as well. In this study, the dependent variable is nominal price for the crude oil expressed in US dollars and real price for the crude oil in rubles. And the explanatory variables are prices for Brent, which is a benchmark of oil prices in the global market, and the volatility of the oil price measured as a moving standard deviation of daily Brent prices. Here is a 20 years historical chart of crude oil prices in the global and Russian market in nominal US dollars. So you can see that prices in the domestic market follow the pattern of the global market, however, is lower, especially after the global financial and economic crisis 2007, 2009. The discrepancy, the difference between global prices and local prices are mainly export taxes. However, after the crisis in 2014, the difference between global prices and domestic prices are not so huge, and sharp decrease in prices in the global market in 2020 also was the same in the domestic market, was sharp decrease. However, if we calculate oil prices in the domestic market in real prices in basic year, our basic year is 2002 in this study. So we can see that this yellow line is nominal prices and blue line is real prices. So we can see that real prices are more or less stable, and from the point of time series properties, real prices are stable time series. The result of the estimation of oil prices, nominal oil prices, show that increase in prices in the global market cause increase in nominal prices. The elasticity is more than 1.37, and also increase in volatility of Brent cause increase in domestic prices, keeping other variables constant. The same result, but a bit different model we obtain for real prices. Real prices less sensitive to the global prices, but more sensitive to volatility of global prices. So in conclusion, the nominal prices in the domestic market depend on the nominal prices in the global market, which is not a surprise, of course. In time of crisis, the elasticity of domestic to global prices rises sharply. Nominal prices are less dependent on the volatility of world prices than real prices, only during crisis. Real oil prices react to both world prices changes and volatility, and the sharp increase in volatility leads to an increase in prices in the domestic market. This is also in line with the dynamics of nominal prices in rubles. Thank you for your attention. If you have any questions.